Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending June 24th, 2016. Well, I guess everybody got it wrong, or at least most people got it wrong. The only one that got it right as far as whether the British were going to leave or not were the volatility charts, and I'll show you that in a minute. But we had a really interesting week. In fact, the Russell rebalancing that happened at the end of the week on Friday afternoon was not even it was kind of a non-event, which happens once a year. Normally that's the busiest and most volume active trading day of the year, but it was kind of superseded by the British vote. Now, for all of our members, we had a great time. We were actually up and trading the markets at 1 and 2 o'clock in the morning, Friday morning. Primarily in some of the assets that I had published to our members, those assets that would move up and those that would move down based on whether the British vote to stay or leave. So we had a cheat sheet that we were going to follow, and then come late Sunday night, as the poll results started coming in, we were just making our bets, and we had a great time. So, and anytime you get in a big event like this, you definitely want to take advantage of it. It doesn't happen very often. And the markets, you generally know which way the market's going to run, but we had some various futures trades that we were looking at playing. Obviously, the British pound was probably the most fun, and it was the most reactionary to the polls as they were closing. And we literally followed it with each closing poll. Starting around 10 o'clock, 11 o'clock at night, New York City time, and all the way till about 2 or 3 in the morning until they started calling the results. So we did well. For those of you that are not in our group, I highly encourage you to check us out. We're having a lot of fun this year. Now, what I have on the screen here is the E-mini S&P 500 futures. You can see that huge bar, that down bar, which was Friday, of course. And you can see the range where we started and the low, and then we closed right here. So we did not really, I was looking to see if we would basically break the 50% mark and then close back up at the 50% mark, but we didn't, and we kind of closed through the weekend, and we were down, you could probably say, in the bottom 20% range of the trading day, which tends to show bearishness. Now, also, we were having our signals here on the bearish divergence as we were moving up, and right in this area up here, we were lightening our load. We were looking at possible shorts. We were putting on trades that we knew. I mean, the British exit vote was not a surprise that it was going to happen, so we knew a week or so in advance. You should have known a week or so in advance. The markets were going to get volatile. I'm going to go through some of the major indexes here and just kind of show you what we can expect. And then I'm going to go into volatility and just show you a couple of different ways to really look at volatility, especially if you're a credit spread trader or you like to sell short puts in the SPX. These are good times right now for those folks. So let me just clear this up here. If you look at the chart, you can see, and I'm going to leave it on the daily time frame, but I'm going to really take it back. And I'm going to take it back all the way to 2009, okay, when we hit our lows down here. And then you can see we've moved up really nicely. The only year that we had, you could probably quibble that it was not a very good year, since that run up was right there. This was 2011 right here. But outside of 2011, when we opened the markets right there and we closed the markets right there, slightly down, but we had some really good, solid volatility in 2011. Outside of that, and the initial start in 2012, where we came up from the open, we came down and about touched it, and then from there it's just never looked back. And then starting in the summer months of 2015, when the Chinese devalued their yuan, we had the biggest volatility move in one day in the history of the markets. We opened or about 7:30 in the morning, the S&P 500 E-minis lock limit down, and then they finally released them, and then they moved back up. And I thought, wow, that was just amazing. The first lock limit down I've seen in a long time, long time. And that includes the 2007, 2008 movements that we had in the markets. But it surprised the market. Anytime you get a surprise in the market, you get a lock limit down move because the price action just does not expect that. And price action and the markets are all about the future and anticipation. So they start building in prices. They try and price in what they predict the future is going to be. They don't wait until the future occurs, see the reaction, and then adjust accordingly. They start pricing it in. So what happens is they're pricing in a positive event, and the prices start going up. And when the event is positive, it tends to go up like that, and you kind of settle right here. So the market will generally, it won't price in, 100%, but it'll price in, 50 to 70% of the move, and then when they finally get the move in the direction the market thinks it's going to do, you'll get 30% more or something like that. So most rat brain traders, they tend to come in up in this area here where the last part of the big move occurs, and then they don't understand why the markets then sell off a little bit. But the markets sell off because a lot of the profit that's already been priced in has been made. Then the rat brain traders start selling. They get really pissed, and then the big boys come back in and pick it up on a dip, and then it goes away again. Rat brain traders are always misaligned with the market and the market thinking. Now, what happens, however, in those situations, and usually the markets get it right. Price action gets it right. But if price starts moving up like this in anticipation of an event, so the starting point was here, and it moves up like this, and then the event doesn't occur, remember the final point of the event occurring would be up here. It doesn't occur, then it would be one of these kind of moves like that. It just goes down like that. Because if the markets felt the British were going to exit, it would slowly start selling off. And then when the event occurs, you get that last bit to where, you'd be down here, right? The price action has adjusted to the new reality of what we're seeing. Okay. So that generally at a very high level is how prices work, right? You've got an event, you starting point here, and if it's going to happen to the affirmative, that would probably be where the final price action is. So it starts moving up in that direction, never all the way up there, and then when it occurs, it comes up and it hits there. And if it doesn't occur, price action starts kind of coming there, and then when it doesn't occur, it goes like that. But if you're up and you're extended here and it really is down here, then that's just that much further you got to go. That's what we have happen. These are unexpected events in the market. Unexpected events. The market pricing is like a petulant child. It's going to always overreact both to the upside and to the downside. And a measure of that overreaction is volatility. And I'm going to show you that in just 1 second. But if we look at this going all the way back to 2009, you can see here this steady, and I don't have it drawn on this screen here, but I can put it on here like that. You can see this upsloping trend line right here. That's defined, right in that area there by a couple of points. We came down here and we tested it back at the beginning of 2016, February the 11th to be exact. And then this is where we're sitting right here. I think the odds favor us coming down and testing this trend line, which would suggest somewhere down around the 1920 area. Now, it's going to be very choppy, but that's what it looks like it's probably going to do. If we break that trend line, we'll come down and test this fib node right here. That was designed from the lows on March 6, 2009 to the highs back on around May 20th, 2016. And that would be the move that we would expect there. And the distance of that move, quite frankly, is not that, it's not that great, right? So if I were to measure it, I think you guys have seen this before, but I'm going to put it in again. A move down like that is only about 15%. Okay, it's not an official bear market. A bear market takes us down 20%. I don't know if we're going to get that. I don't think it's going to fall like that for now. I'm on record as saying that by the end of 2017, I think we're going to get our 20% pullback. I don't know what's going to be the catalyst that's going to drive it down. Perhaps it could be all the stimulus that Europe and Japan and the U.S. is doing or not doing is going to be the catalyst when the markets realize that all that spending and negative yields and interest rates just aren't working. And then the markets say enough is enough. We're going to sell off until the valuations are more in line with where we see the economic growth on a go-forward basis. So who knows how this thing is going to shape out? I certainly don't know. But what we do know is that we can follow this price action and react accordingly. Remember, a 20% pullback is going to take us right down to about the 1700 level. I believe that we'll probably see something down to around the fib node here, 0.382. It's the first official fib node pullback from the May 20 highs made in 2016. And if you look at this, that fib node, I mean, to me it makes sense because on this daily chart I could extend this fib node out like that, and it was the .com bubble high and the 2008 high before we crashed. So that to me makes a lot of sense. And most bear markets are not 20%. They generally run 25 to 35%. Okay, and of course this big move down here and this big move down here was well in excess of 50% of the move. So to me, 25 to 30% of a move to the downside, it makes sense to me, right? These again, well over 50% to the downside. So we're going to have this occur. Again, I don't know the timing of the occurrence, but we're going to have it. We'll watch it and we'll get a heads up on it when it occurs, right? We'll know. So getting back to the E-mini S&P 500 futures, you can see right in this area here. This to me looks more like a topping process than a higher run or a consolidation. Remember, there's a couple of different ways price action can occur, because we've got time down here and we got price over here. Most people, they only look at price, but they don't look at time. And sometimes you can move up and then you consolidate over time and then you move up. You consolidate over time and you move up. That's a typical move up pattern. And then of course move down is just the same, just go in the opposite direction. You consolidate, you move down, you consolidate, and you move down. So, you know, the optimistic side of the market would say this is just nothing more than a very long, wide consolidation pattern. And then once we break free, we're going to run to the upside like that. I don't believe that is going to occur, and we continue running to the upside until Europe can clear its economic hurdles. And clearly the Brexit, it's going to take 1.5 to 2 years to wind itself out. The markets, you know, the less clear the future direction, the more choppy the near-term market. So we can expect clearly a lot more chop. I think some buyers may step in, but most will probably sit on the sidelines and seek more clarity over the next couple of weeks. So we can expect chop to slightly downward action is what I would expect. Any upward movement to me is I'm not going to jump on board at this time. Now, if you're swing trading or short-term position trading, you can do very well, because you can get a 2 or 3 day move that's, you know, 100 E-mini S&P 500 points or 150. But don't just say, okay, now it's time to go all bullish. If we look at our weekly chart here, you can see again on the E-mini that we're settled in this range right here. This range we will break. Okay, it's the first long, wide consolidation range that we've had, and it's a lot of points, right? I mean, you're looking at a very, very wide range here. I think from this consolidation standpoint, you're looking at, let me just get this thing back on here again, and it's just going to be an approximation, but roughly right in that area there, you're looking at about a little over a 300 point wide consolidation. So we're varying either one, and we're going to break one and say bye to that break and then just run for a while. I think the break probably favors more the downside, which would give us, you know, that would set us up for more of a bearish type of scenario. But understand, prior to the Brexit vote and them leaving, and then post-Brexit vote with them leaving, the unknowns are more about the relationship that Britain's going to have with the EU and the US. Their trading partners are not going to disavow their trades. So from an economic perspective, from a corporate earnings perspective, we may see some shift and a little bit of uncertainty. You saw the banking sector really take it in the shorts globally because there's no interest to be made in the banking sector. That's how banks make their money, with net interest margin from what it costs for them to borrow and what it costs for them to loan. And the lower interest rates go or into the negative, banks are just not really a good place to be. But banks, the valuation of banks and some of the global banking centers, there's going to be some great valuation plays in these. Now, if you buy any of these banking stocks, you're going to need to hold on to them for a while for this thing to play out. But I think it's going to be one of those kind of scenarios. If we come back to the daily chart again, you can see here on this daily chart the volume here over price, all of that volume. You can see all of that volume here. That's a lot of volume at that level. That means there's a lot of overhead resistance for potential selling if price action gets up here again like this. I think when you get a really fast move down like that, what happens is people get cut short. They have a lot of losses, but they don't sell. If price starts to move back up in this area here, they'll probably sell and just stand aside. They'll be happy to break even on some of these trades. So you're going to see this volume here over price really react as a more of a resistance point than anything else. Now, if I come in here and put my indicators back on the screen, now it gets a little bit busy. I understand that. For our members, you understand we use these all the time for a combination of day trading, swing trading, and longer term position plays. But you can see here this blue line right here represents the opening price of the S&P 500 futures for 2016. This is where we closed the day. So we're now back in the red on that one bar. Okay, and I think the direction, because we closed, towards the bottom, and of course it's a bearish engulfing pattern, because right here to right here, we literally engulfed going all the way back to March of this year, all of these prices. We took out all the gains that has been made since the middle of March in one day, right? So this is where we're sitting, and now we're sitting right at that area there. So you could, right around the middle of March is where we're sitting. So that just shows you how quick it can be. And because the price action, you can see here on this daily screen, the price started to sell off a little bit, but then when the bookies and the exit polling or the pre-poll results suggested there would be a win, the market started going right back up. And then right the day before, 2 days before, we actually moved up, and then into close it went even higher. But they got it wrong, and that caused that big shift in sentiment and volatility. So this is where we are on the E-minis. Notice the 200 EMA, we blew through that. That'll serve as a little bit of overhead resistance going into next week. And if we look at the Dow, it's going to be the same thing, right? Here's the Dow. We're below the opening price of the year for the Dow. The futures closed down 663 points. You can see the 2016 high. 2016 low is way down here. We got a little bit of a support zone underneath us, but the Dow just, it really kind of gave it all up. If we look at the NASDAQ 100 futures, you can see here NASDAQ has really been having a rough time of it this year. We've been making lower highs all along, unlike the Dow and the E-minis. We've just started that slow roll, and we're sitting here in a support zone, a small price support zone, and should we blow that, we're going to go back down and could probably test the 2016 lows at this low pivot here made on February the 11th. So we got to watch the Dow. If we look at the NASDAQ composite, which is all of NASDAQ, you can see here, again, it was really interesting. We had the day before the vote. You can see it moved up actually into the green for the year. And then boom, we just took it off and then we went right back down again, right? And so the pattern would suggest a more downward action. All the charts are indicating if we were to draw the channel like that, you know, one of these kind of things like that. So we've got to watch. And again, after the Elliott Wave 5 that we had here like this, and we got a little bit, but not enough bearish divergence for me to really pay much attention to it. But we've got this ABC pattern here, which would suggest a little bit of a reflex bounce, but then a roll back over again. So we've got to be very careful here on that. And then finally, the Russell, which has done, you know, has made a big comeback. The Russell has made a great comeback, but on Friday, it really gave it all up. You can see the Russell here. We made a higher high just a week or so before the vote. And then we did one of these dips and then boom, we gave it all up. Now the Russell, again, if you look at the trading range for the day, here is the high point, here is the low point, and the Russell was right here. Not quite at the 50%, but it closed a little bit better than the other indices. You can see the opening price of the year for the Russell futures. We are still down below. The other thing here is, unlike the Dow and the E-minis, you can see here that the red line is below the yellow line. The yellow line is the 200 EMA. The red line is the 50, and both of them are sitting right at the opening price for the year for the Russell. So again, be very careful next week. You know, the markets may start off strong, or I'm sorry, they may start off a little bit weak. We'll get a little bit of a bounce. We may get like a bull trap where the markets do one of these numbers where it sells off again, it tests the pivot low made on Friday, and then it starts just running like this, and then people jump on board, and then it rolls back, takes out that pivot low, and moves lower. So the pivot low defined on Friday is going to be a key pivot point for us going into Monday's open. Now, I talked about volatility. I want to show you guys something. If we look at the VIX right here, let's focus on the VIX for a minute. This is a daily chart of the VIX. And as you can see here, let me just scrunch it down a little bit. For you options traders out there, you can see I've got my VIX color-coded and designed into zones. It goes up to zone 5, which is a black swan event type of zone. And I've got them divided between VIX pricing. Less than 15 in the VIX, you're kind of in the green zone, where credit spread traders, you have to go lighter on your capital deployed, about 25%. You know, if you're over 15, less than 22, it's just kind of a rule I look at. I don't want to deploy more than 40% of my capital in any kind of credit spread trading strategy, whether I'm just short puts or I'm short bull put spreads. And then zone 3, you can start to deploy more capital. Zone 4, you can deploy more capital. Why? Because with higher volatility, you can get further away from the money, or as I call it, further away from the hand grenade. And the further away you are from that explosion, the better off and the safer you're going to be. But you get the premium for it. So it's like everything working in your favor. And because of the tendency of mean reversal in the volatility, that's why option traders love this, the VIX. And you can see here, we had that black swan event last August 31st. This was the greatest rise in volatility in the shortest period of time ever. I didn't say the volatility went the highest. I just said on a percentage basis, the movement up was the largest movement in the history of the markets in that short period of time. Why? Because the markets weren't expecting what happened, which is the Chinese devalued the yuan. So any unexpected event that sends trauma through the market tends to move volatility. Now, if you'll look at the VIX here, the VIX leading up to this Brexit vote, it was in this area right here, you know, right around 21 to 22, right? It wasn't that high. And the markets weren't, volatility-wise, the markets were not that overly concerned about it. Not like on February the 11th when the VIX was up around 31, right? But you can see that here at this level here, the markets weren't as concerned going to the Brexit vote. A lot of the market had already been making their bets that they were going to vote to stay in. They said, no, it's just not going to happen. However, and you can see what volatility did on August 31st. It went up to 53, the VIX, up to the high. But let's look at VVIX, which is the volatility of volatility, okay? You can see on that August 31st date, the volatility of volatility went up over 210. Okay, that showed that volatility can double very quickly. 210 was the price. But now look at this right here, which I find very interesting. If I were, let's just zoom this thing like this. And if we look at the volatility of volatility, and let me just draw this box right here like this. It was at, before the vote, we were up in this area here. So the volatility of volatility was very, very nervous. The VIX was not as high as the volatility on the VIX was. And that said that the markets were very nervous, or at least the volatility was very nervous about this price, probably more so than normal. If you look at February the 11th right here, the volatility on volatility was relatively low, and that was the low point going into the February the 11th downdraft. The volatility on volatility was right here. However, if I show you the VIX was already very high. Okay, so the VIX had already made its move. So this had not made its move. And if you can look at the December time frame, the volatility on volatility was very high, yet the VIX was very low. So net here, when you've got a high VVIX and the corresponding VIX is not as high as it should be prepared for some crazy times. It doesn't guarantee it's going to happen, but it does tend to show that the odds, you're not going to have this normal random distribution, where you get, like one of these things like this, where 68% of the time you fit inside here. What happens is when you get the volatility on volatility like this, then you get one of these things where the distribution, instead of coming down like that, it kind of goes like that. So you get this non-standard fat tail, which you may have heard the term of fat tail, which says they're pricing in a potential down move here in this thing, and you get that log normal fat tail event. And that's sometimes, and it may be hard to understand, but over time you can do this. And if you go back in your charts and you look at all of the major events where the market's really cratered, generally you're going to find the volatility on volatility kind of giving you a signal, and if it's at odds with the VIX, then be very careful. You can see right here, going into this on this daily chart, on the 13th and on the 22nd, we were up in these high levels, over 125%, right? That's a week or so before the event. And if you look at the VIX, a week or so before the event, the VIX actually was one of those things where it was down in this level right here. A day before the event, the VIX was like at about 1756. Yet the volatility on the VIX was way up here. So that says be prepared. It showed also a lot of people were starting to buy volatility products. We were one of them. We went out and bought way out of the money VXX calls, or at least I had our members do that. And we made, over 5 to, I think I saw some members saying 400%, and I've got some that were doing 800% on the day, right? And they're cheap calls, but you can do them for a short-term binary event, and bam, you hit pay dirt, you know. So these were some of the things I was doing with some of our members. The other thing that really concerns me, and it's going to start to affect the markets, and I hear a lot of people talking about it. I've been a bond bear for a long time, but you can see here the bond market just went absolutely crazy, and we made new 2016 highs in bonds, which means interest rates are very low. And the bond market is going to really, I think it's overextended personally. The bond market was in this pattern right here. And then leading up to the Brexit vote, you can see how bonds sold off going up to the vote, and then boom, it hit, meaning interest rates were going up a little bit, but the markets got it wrong, and bonds was up in this area in a very short period of time. In over 9 hours, actually. We were watching it at 2 o'clock in the morning, New York City time. Really amazing. And then we closed right here, which was right at about the 50% level. So we're going to be watching bonds very closely. Now, there's a lot of other currencies and movements out there. Gold is one of them. We had some members trading gold in that event as well. You can see gold made a new 2016 high price with gold, moved right up to a natural target level that I had right up here, which was around 1370 roughly. We hit 1362, so we can expect some chop up here, maybe an ABC pattern before we decide which way we want to go. If the markets continue to tumble, then you're going to see us continue to move higher in gold, okay? And then silver market, same thing. Oil market, you can see the oil market, as I said, it was one of those markets that were going to fall in sympathy with equities, and that's what we did. So the next key event for the oil market is watching the 50 EMA. You can see where the 50 EMA has kind of held the market going all the way back to April of this year when we bounced off these February 11th lows. Now, we've been playing the oil market to the upside off the February 11th lows and done very well with it. But now we're going to have a little bit of chop here as we try and go higher. But oil is now, in times of higher volatility and downward movement, most of the markets become more correlated with equities. So we're going to watch this closely, but we've got some great opportunities coming up. For our members this Sunday night, I'm going to go through our Superfly trades, which did very well this past week on this move down. I took some screenshots, so I'll show you how that works out. We'll be putting some of those on in our secret trader for next week, and we'll be running those because they worked out very, very nicely. So they're easy, they're easier to adjust, and you know, we scalp profits off those things. Otherwise, everybody have a really great weekend, and members, I will see you Sunday night. If you're not a member, I highly encourage you to come in. We're having a fun year this year. I didn't even go over the currencies. Before I do this, just one quick thing. We were trading the pound all night long Thursday night, and if we go into the British pound here, you can see on the pound, I mean, let me just put my symbols on here. We've made a new, in fact, this was almost, we haven't seen these lows since the middle 80s in the British pound. Right in this area here, I was long the pound, and then right as the vote came out and it started falling off, we started shorting the pound, and we just rode it down like that. It was a great trade for us as well. I think the pound is going to start, well, it's going to get pounded again on that trading range right there from the high. It made the high and the low for the year on that one-day move right there, and we closed down here in the lower quartile. Any move up here is probably going to be sold off until the British get their act together, because I think the pound is really a very solid currency. Keep in mind the British is the 5th largest economy in the world, or Great Britain, and their economy is not that far behind the U.S. as far as economic growth. It's better than Germany right now. So there's going to be some buying opportunities in the British pound as well, just not early this next week. It'll be too volatile. All right, everybody, have a really great weekend. Members, I'll see you Sunday night. Take care, folks. Ciao.